Welcome everyone to Vested Interest. This is Shane back for a Stock Review of the Day video. We are going to take a look at one out of the utility sector, AES. It is May 19th, Monday. Happy birthday to my older brother Joe. It is his birthday today. I believe he's 47. I don't know that he actually watches the channel, but happy birthday anyway. Now, if you could do me a big favor, and watch time is also one of the ones, so you could watch this video to the end. That really helps. Clicking the thumbs up button, hit that subscribe button, join us on this journey to financial freedom, join the vested interest community, click the notification bell down below as well. Doing all that, again, helps the YouTube channel spread the videos a little further. Share with anyone you think that might find value in the content. Drop a comment down below. Let me know what you think of the videos. And a special thank you to the viewers and subscribers of the channel. You guys and gals are awesome. The channel continues to grow because of people like you. Now, this is the vested interest stock screener. This is the criteria we will be running through in the video today. It must meet 5 of 8 to make it onto my watch list. Just because it makes it on my watch list does not necessarily mean that I am buying. If this was a company out of the financial sector, like a bank or an insurance company, we would add in price to book, with 1 being fair value. Don't blindly use 1 for companies outside the financial sector, company out of the industrial sector, the industrial sector, information technology sector, any of the other sectors out there. You can use price to book. Just make sure you're looking at price to book compared to the company's historic average, what it is today compared to its historic average, or compare it to other companies in the same sector doing the same type of business. All right, back to AES. Check them out at www.aes.com. That is their homepage where I pulled this information from. And we went back in time to the 80s, 90s, and early 2000s. If you want to see the rest of their history, you can go check them out at www.aes.com. Again, www.aes. That is their homepage where I pulled this information from. 1981, Roger Saint and Dennis Bake from Bake, whatever you want to, however you pronounce that, form Applied Energy Services. That's what the AES stands for, an energy consulting company. As the first CEO, and Roger became AES first CEO and chairman of the board. 1988, pioneering the model of independent power producer, IPP, AES became the first and largest IPP in the U.S. with 3 cogeneration plants in operation in California, Pennsylvania, and Texas. 1989, caring for our carbon before it was common, AES created the first documented carbon offset program in the U.S. by planting 52 million trees in Guatemala to offset carbon emissions from a plant in Connecticut. In the 90s, I'm not going to read through all these, and I'll touch on a couple in the 2000s. 1991, going public with investors, AES listed on the New York Stock Exchange. That's a pretty important one. That's why we can buy them today. 2001, focusing on improving lives, AES entered the retail customer arena with acquisitions of IPL in Indiana. 2002, Paul Hanara becomes AES third CEO as the company made its first investments in wind and solar. 2003, Dick Barman becomes AES second chairman of the board. Seeing a greener energy future for the world, AES made an investment in wind generation, acquiring Seawest, one of the largest wind companies in the U.S., and starts its expansion into cleaner energy sources. And again, down in Latin America, they are kind of spread out around the world, and you can, again, go to their homepage and see all the different acquisitions, investments over time where they've spread out to become a huge utility company, not just here in the United States, but all across the American continent itself. And again, www.aes.com. They are a utility company. Now, the reason we're taking a look at them, down 4.1% on the day. We are talking about the AES Corporation, ticker AES, out of the utility sector. Closed out the day at $11.71. Looks like they're up a little bit in the after hours when I pulled this information. 52-week range as low as $9.57, as high as $22.21. They are not quite within 15% of a 52-week low. They need to be at $11 even or lower. Really, anything under 11 bucks. Market cap of $8.337 billion. So they are a small cap company here. Beta of 0.94, just less volatile than the overall market, 1 being the market's volatility. Price to earnings ratio, PE ratio, seems low at $6.36 per share. Earnings per share at $1.84 per share. Earnings date coming up sometime between July 30th to August 4th, in that window there. Forward dividend is 70 cents. They are a quarterly payer, I believe. We'll see that here towards the end of the video. This is the first time I'm taking a look at this company also. with a nice starting dividend yield of 5.71%. Ex-dividend date May 1st, so we are past that. You would have had to been buying them in April or before, or owned them before April, the last day of April there, to get the next dividend, which did pay out on the 15th. So you would be in line for the next dividend, but you're going to have to wait a few months to get it since they just paid out. 1-year target estimate, at least according to Yahoo Finance, $13.94. So they don't see them getting back to their 52-week high, and not even really close, but they do see some upside from where it currently sits slightly. Jumping over to the right, I'd like to look at dividend yield theory to see if the company is potentially undervalued. It's just a quick check, and it's pretty easy to do. To do it, you take their 5-year dividend yield average of 3.33%. You compare it to the current 5.71%. Or over here, forward dividend, same number, 5.71%. Since it is higher than their 5-year average, that speaks to undervaluation, at least according to dividend yield theory. Now, this is uncommon for utility companies. Very low payout ratio on this one. Usually you see utility companies in the 80, 90% range, maybe sometimes even higher. 70%, 60%, but not a lot of them have a payout ratio this low, 37.69%, very low for a utility company. Dropping down, we want growing free cash flow over time, because typically if a company has growing free cash flow, they can do some things with it. They can pay down debt, make acquisitions, reinvest back into the company. They can pay a dividend, which this company does, and they can raise it over time, which is what we should want as dividend growth investors. Now, utility companies never look good. They have a lot of charge-offs, write-offs, for example. So I never see very good numbers in utility companies, and this one looks no better. 2021 looks like they wrote off quite a bit, negative $214 million in free cash flow. 2022, $1.8 billion in negative free cash flow. 2023, even more, $4.69 billion, and 2024, $4.64 billion. So definitely up and down on the free cash flow, not what we want to see, and definitely a lot of either charge-offs, write-offs, acquisitions they're writing off. Something's going on here where they're writing off a significant amount every year, which again is not uncommon. They are repaying debt, not buying back shares, but you want to compare the repayment of debt to issuance of debt to make sure, like say 2021 here, 4.4 billion repaid. Well, if they issued 5 billion, they really didn't repay anything, right? So you want to compare the issuance of debt to the repayment of debt and see if they are indeed paying down debt over time. But it doesn't look like they're buying back shares. At least not recently. Stockanalysis.com. This is another source. I am not affiliated with either source, but it is another source I go to for information. I recommend more than one source so you can make sure the information you're looking at is accurate and up to date. They do have 7 analysts that have taken a look at this over at stockanalysis.com. They call it a consensus buy, though it is right on the edge of a buy and a hold. And if you were to go to stockanalysis.com, you could click on these tabs and see how many might call it a strong buy. That's what this would be. A buy is where it's at. A hold, right on the edge of a hold and a buy. A sell or a strong sell. 7, the consensus of the 7 is a buy, but just slightly. They do have a low estimate of $7. That would represent a 40.22% decrease from where it currently sits. Average estimate of $12.86. That would be a 9.82% increase, and that's pretty close to what we saw with Yahoo Finance on the previous page. High estimate of $17 would represent a 45.18% increase, and still would not get you back to that 52-week high we saw on the previous page from Yahoo Finance. Jumping over to the right, I'd like to look at return on capital employed to see how well the company is reinvesting its capital back into itself. And I like 10% or better. They're a little low at 4.68%, but again, utility companies always are. I never see really great numbers with these companies. Earnings per share growth, I like 5% or better projected over the next 5 years. They're sitting at 3.53%, so a little bit low for me there. Revenue growth is forecasted at 9.81%. This is not part of my initial screener, but this is one that I look at whenever I do more of a deep dive into the financials of the company, which is what this screener is doing. This screener is giving me an idea if I want to do a further deep dive into the company's financials, like its revenue, like its margins. Are they expanding? Is it paying down debt? That sort of thing into their balance sheet, their income statements, that sort of data. All right, let's look at their history as we wrap this one up. Quarterly payer, like we mentioned, 38.54% payout ratio, very low for a utility company. Dividend growth is 2.97%, so decent for such a high dividend payout. Growth of 10 years, buyback yield. When they are buying back shares, they are not doing it efficiently. They are issuing more shares than they are buying back. Shareholder yield is positive, though, at 5.83%. They do pay out off schedule. Most companies start their payments in March. This one starts in February. So February, May, August, November timeframe. Going back to October 2022, they were paying 15 cents and some fractions of a penny. January 2023, they raised it up to 16 cents. January 2024 up to 17 cents and fractions of a penny, and the most recent raise, it looks like January 2025 up to 17 cents and 595 fractions of a penny there. So they are raising the dividend over time. Looks like the next one will be around January of 2026 if they maintain that growth, which is again around 2.97%. All right, let's check this screener. Understand the business. Again, they are a utility company. They've made a lot of acquisitions to spread across at least the American continents here in America, in South America, and a typical utility company. Getting into wind and solar like most are, different avenues for creating and generating that energy. Growing dividend, yes, it is growing over time, about 3%, just under 3%. Dividend payout ratio is well under 75%. They're in under the 40% range, so very good again for a utility company. Check valuation based on dividend yield theory. Dividend yield theory says they're potentially undervalued, so check there. Now here's where we start to get off tracks. It is not quite within 15% of a 52-week low. Return on capital employed was not over 10% or even with 10%, so no check there. And earnings per share growth was under 5%. So we're only looking at 4 of 5, but if this was one that you were interested in, it's pretty close to 15% of a 52-week low, and if it dropped down to, like I said, $11 or lower, you'd get that 5th check. And maybe do more of a deep dive on it. And you could do more of a deep dive now if you're interested in the company. Just because it's not going on my watch list does not mean it can't go on yours. Let me know what you think of AES Corporation down in the comment section down below. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. So drop a comment. Let me know what you think of the video. Let me know what you think of AES. And if you have a company like AES you'd like me to cover in the Stock Pick of the Day series, drop it in the comment section down below. I'll work it into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend. We'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion, investor, educational, and entertainment purposes. Investment involves risk. You can lose money to never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor. For those of you who made it this far, thank you for watching. Don't forget to subscribe, share with anyone you think that might find value in the content, drop a comment, and again, special thank you to watching to the end.